G'day everyone, welcome to this rundown for global equities, and we had a bit of an interesting week last week, a bit of a pullback going on in America, while we've got Europe still looking extremely strong. But look, overall, I think this is just a pullback in an ongoing bull market for 2015, so I'm still very positive about things. Now, just before I get into the actual rundown for last week, I just want to cover to non-members just something on the Alpha Global Fund that the details were sent out to most of you last week, and I just want to touch on that briefly. So look, I've thrown my heart and soul into this for the last year or so and produced some really good results, as you may have seen in the material that was sent out during the week. The initial investors are very, very happy. The results are all above the fund's goal of 25% a year or better. So every single investor is doing better than that. Now, of course, past performance doesn't offer you any guarantee about how things will go in the future, but I can tell you that we've got a very robust and very repeatable process. So I remain very confident about how this fund is going to perform into the future. But look, I've had some feedback that some non-members are skeptical of the results. The results, if you like, are almost too good. Now, skepticism's fine, but skepticism with a closed mind is not fine, because it's just going to hold you back from achieving what you could do financially. So therefore, I really urge you, if you've got any interest but you are skeptical, then contact me directly. The other point I want to make before I just quickly touch on the results again for those of you that haven't seen the material is that higher returns do not have to mean higher risk. I know that we've all been conditioned to think that the two are intimately linked, but it's just not so. If you understand how global markets work and where to go to look for the best opportunities, you can produce much better results and in fact take less risk in the process. Now, just quickly, for those of you that hadn't seen the video, hadn't seen the results, these are a representative sample of investors' results in the fund. Their funds have been invested for those periods that are shown there, between 4 months and 7 months. You can see the profit percentages there in that middle column. They're all pretty impressive. And then the opening and closing balances on the end. Now again, just the reminder about past performance, but these are all pretty good results. So if you didn't see all the information package that went out last week, then there is a link in the description below, and that'll give you a lot more detail on how the fund actually operates. Or if you wish, please feel free to contact me directly for any further information. So let's move on and have a look at last week. The S&P 500 was down 18 points on the week, but I see this as just a minor pullback in an overall bull market. There's lots of people out there that are telling you that we're in a major topping phase and the market's going to crash any day now. I just don't believe that that's valid. And the fact that the Russell 2000, which is the small cap index in America, the top 2,000 or 3,000 stocks below the major stocks, the fact that the Russell 2000 is doing significantly better than the S&P is really one of the key indicators that I look at. And if the market was topping out, then I can tell you that the Russell 2000 would be in serious decline. And it would be underperforming the S&P by a significant margin. The fact that that's not happening is just one element of proof. Another element is that the volatility spot has only spiked up to about 15. So despite the fact that we had a couple of triple-digit falls in the Dow Jones through the week, and look, the markets might go a little bit lower in the short term, but no one's really fearful. The VIX index has just not spiked up yet. The final point I want to make about the US market before I get to the charts is don't let what's happening with the S&P index control your attitude to US stocks. If the S&P were to be flat or only go up by a minor amount for the remainder of this year, that hides the fact that some sectors, but particularly the sectors that I'm involved in, are doing exceedingly well. So let's have a look at some of the charts of relevance. We'll start with the monthly chart on the S&P 500. And as you can see, there's just no interruption to the uptrend. Now, if you look at the RSI down here, you can see that it's been up above 70. It's been in overbought territory now for a long time. May 2013 was when it first got up into that overbought territory. So that's nearly 2 years, but the market has just continued to move higher. So the fact that it's overbought really doesn't mean anything about anything on a monthly chart. So you can see no interruption to the trend at this stage. Let's just zero in a little bit on the daily chart. I've put a Fibonacci scale on here. So far we've gone through the 38.2. At the moment, the support around the 50% mark is holding, but I would concede that a move down towards 2028 is possible, and also possibly the first Fibonacci level of the next time frame. So looking at a bigger time frame, I'll just pan back a little bit so you can take that in. So looking at the big time frame, which is going all the way back to the lows in 2011. So that was the last major correction. So if we look at that big picture time frame, we've got some support way down here, but that's miles away. I don't think that's any chance at all. So we've also got, if we look at this bigger time frame, coming back towards October of last year. So again, that's the last time that we saw any sort of median-sized correction. Kicks in about 2004, 2005, and also corresponds with these peaks through here in September. So I would think that's about as far as the market's likely to drop, a little bit further down, but not too much. Let's just have a quick look at the Russell 2000. So as you can see, there's been very little retracement in the last week. That's looking very strong, and basically around all-time highs. And the Nasdaq is also looking the same. Just a quick look at the Nasdaq. So if we pan back to 2000, we've got some all-time highs. We haven't quite made it up to the all-time highs of 2000, but we've certainly exceeded the previous peak, which was a substantial one in September of 2000. So whichever way you look at it, this bull market is still very much intact. Let's just have a quick look at the Australian index just for the sake of it. This is the ASX 200. Probably doing better than the American market in the short term, but look, I think this is just really about the banks. It's not really telling you much else about the Australian market. So moving on now. So the US dollar, that was the other chart that I wanted to show you. So we had some consolidation and then a significant breakout. And I think that's because the prospect of the US raising rates this year, I don't know whether they will or they won't, or how much they raise them by. I don't spend a lot of time thinking about that. But the market is factoring in rate rises, while central banks everywhere else around the world are easing policy. So it really is making this pretty much a no-brainer trade. I believe that this will result in the Australian dollar heading below 70 cents in coming months. So still further to go down on the Aussie dollar. So the ASX 200 index ended down by 85 points for the week. It should continue higher in 2015. The value is not good. But people aren't worried about value. It is purely about buying yield. And now that the RBA has joined in the club of central banks that are easing interest rates and trying to stimulate their economies and weaken their currencies, then yield stocks are going to continue to be bought. And we're going to see yields go down. We're going to see stock prices go up. And that's just the way it is. But it doesn't mean that there's not a lot more risk in Australia than there is in America. That's for sure. So let's just have a look at those other couple of key charts. I'll touch first of all on the, I mentioned the VIX index. So let's just have a look at the VIX. So you can see that there hasn't been much movement up in the VIX, despite the fact that the US market has pulled back. And as I said, two triple-digit falls in the Dow Jones. In fact, more like 200 to 300 points. Now you can see that we're not far off the base in the VIX index, in the fear index. So that hasn't spiked up at all. It's nowhere near as high as it got back in February. So I don't think there's any change to market sentiment whatsoever. Just quickly looking at the US dollar. This is the US dollar, and as you can see, it's just absolutely rocketing higher. If we go right back, we've got previous highs around about 120 on the US dollar index, and that occurred in 2002. The US dollar then went into a massive decline as quantitative easing really started. So during March of 2008, March to about July of 2008 is when the US dollar really hit bottom. Since then, it went into a very big sideways range, and it's just absolutely blasted out of that sideways range without too much stopping around potential resistance level. This was a key resistance level around 92. You can see the index moved higher, and then it pulled back a little bit, but it didn't even pull back far enough to test that breakout. That's how powerful this trend is. It virtually just went sideways, and then it just charged off again. So I think the US dollar is going to continue to appreciate against everything, against the euro, against the Japanese yen, against the Australian dollar. And that's why I think we'll see the Australian dollar under 70 in the not too distant future. Moving on now to commodities. Gold steadied a bit, was only down $5 on the week, but look, it's looking very shaky at 11.58. The US dollar going up, and the talk about higher interest rates is absolutely killing the gold price. The gold price has got little chance of performing while that's going on. The only thing that will change that is if and when people start to fear that the monetary system is going to collapse. And then you could get interest rates going up and gold going up at the same time. But until you get that fear about financial instability, then people just aren't going to be interested in gold because it doesn't pay a yield. Now, there's going to be a lot of sell stops below 11.30. We'll have a look at the chart in just a sec, but there's going to be a lot of people that have got their sell stops just under the previous low. And if that happens, there's going to be a massive amount of selling. And I think that will then bring $1,000 gold into play. Despite the fall in the gold and a lot of people predicting much lower prices, gold stocks are still continuing to outperform, which creates a little bit of a dilemma. On the one hand, you'd think that's a good sign, but look, I just think the risks are too high to be long gold stocks, because if gold does go below 11.30, I think you'll see a tsunami of selling, and you could see substantial gaps down in the price of gold and gold stocks, which doesn't allow you to get out. So don't think that you can play this and then if gold breaks that level that you can suddenly get out and all will be well, because we're going to see some substantial gaps in gold stock prices if that occurs. So my view is that the risks are just way too high to be involved in gold stocks at the moment. So let's take a look at gold. So first of all, this is gold on a daily chart. So you can see we're very close to this triple bottom. But let's take a look on this is the gold chart on a daily. This is the gold chart on a weekly, which is a little bit clearer. So you can see we had key support at 11.92. That broke in what looked like a final capitulation low in November of 2014. We then moved strongly back into the range, which looked, that was just a classic final capitulation and reversal, and it looked like the start of a new bull market in gold. But since then, the US dollar's taken off, and this has fallen right away. And there'll be a lot of sell stops just here. about 11.25, 11.20. So if that breaks, then it's going to be a case of look out below, and the next stop I would think has got to be down around this 1,020 area. So that's how I see things unfolding with gold. Let's just look quickly at the HUI index. So I'd previously tracked out that we get a bit of a little bit of a pullback after the initial surge. So we had higher high, higher low. So all the elements in place. We even broke these highs here. So technically this looked very good. Bit of a mild pullback and then off. That hasn't happened. It's just fallen away. Now it's not as bad as the gold price, but it's still pretty bearish. So it's just not a place to be at the moment. Moving on now to commodities. Copper moved fractionally higher to $2.66, which is a positive sign on the global economy. And considering the US dollar is going up. So that's a pretty good effort by copper. However, the London Metal Exchange inventories are on the rise again. Chinese demand is slowing a little bit. So I wouldn't be surprised to see the price of copper turn back down again. Now, crude oil, as I've been saying for weeks, don't get suckered into the bit of a rise in crude oil. It was always going to go back down again for fundamental reasons. There's still a huge amount of oversupply of oil. So the price is now broken down from a bit of a consolidation zone and is heading lower, and I think there's a chance crude oil could go under $40. There's the spot copper chart, so you can see we had an initial plunge, a little bit of a recovery, and now sideways for the last few months. But I'll include crude oil charts. This is the West Texas Intermediate crude on a one-year chart. So you can see we've fallen massively from $100 down to $45. We had a bit of a blip up to $55, and now it's back down almost to a double bottom again. And if that double bottom breaks, then you're going to see another decline to the downside. Now I just want to take a look at this final little area here where we had some consolidation just in this area here. So let's just zoom into a 3-month chart. So here's the consolidation through here between 50 and 54, and then we've had a break, and it's broken down, and we're basically at a double bottom now. So anything below here, and we'll see more selling in crude oil. So the message there is, yes, there'll be a tradable bottom in energy stocks, but we are not there yet. So overall, from a strategic approach, the market trends are higher, but bear in mind volatility will keep spiking throughout this year, much more than last year and the year before. So active management of whatever you're doing, whether you're an investor or a trader, then active management is essential. Be quite prepared to take some profit as it comes. Global markets, I believe, are going to follow central bank easing. We've seen Europe in a massive rally situation. The German DAX is at all-time highs. The UK index is still around its all-time highs. So I think that those trends are going to continue. The Australian market is now starting to follow now that the RBA is clearly on an further easing bias. Then I think you'll see the Australian market probably also do okay as well. So just to wrap it up, if you want some global exposure, and you must be reading everywhere, people are saying you've got to get outside the Australian market. It's just there's no value here. The returns are nowhere near as good as what you can get for the risk overseas. So if you want some global exposure but you don't wish to do it yourself, then there is the Alpha Global Fund that I run. Your money and what's going on within that fund is very transparent. You can see absolutely everything that's going on there just by logging in. So you've seen the information through the week. I would certainly recommend that to you. For everybody else, for non-members, if you want to talk to me about other trading and investing issues, that's my email address there. A bit of a long one this week, but a lot to cover. So talk to you again next weekend. Cheers.